All right, all right. Welcome, welcome. I apologize for being a couple minutes late. But it's a rainy day here in Chapel Hill. It's Mark Yusko from Morgan Creek, and excited to have everybody here today. Not my favorite topic, but we will make the best of it, and hope everybody is safe out there, or your loved ones, and the like. So around the world, those two really are cowboys. The global market impact of the Iran conflict. On the left, we've got the two cowboys going up against the now deceased supreme leader. And on the right-hand side, the global forecast is higher oil, lower stocks, and a lot of volatility and a few fires. So we'll skip over that words of wisdom because I didn't finish it. We do the 10 surprises. We did that in January. It seems like 100 years ago. It's been a quick one. The surprises go to consensus. We asked ChatGPT for consensus, and it gave us a bunch of things that was gobbledygook. Grok was worse. I kind of went through this last time. The second attempt was better. Third attempt was a little better, but none of it was very accurate. And you can see oil prices, $75 stable. No one really predicted war. Although, interestingly, if you go to this segment here, the Economist cover, it's a little spooky. I mean, like seriously spooky. If you really look at that picture, it's almost exactly what's going on. I mean, tanker ships and missiles and individuals who happen to look like other individuals. And I mean, it's pretty crazy, almost like prescriptive programming. And the investor community kind of nailed it in terms of what they were worried about, geopolitics. And geopolitics has been the watchword. So, by mid-February, it appeared that U.S. involvement in Iran was imminent, a 90% chance. And, what I think is interesting is they laid out these 4 future scenarios, all of which were like, oh, we go in there, we drop a couple of bombs and we're done. Yeah, we're going to get into that, but I think people were overly optimistic about how bad this was going to get. Polymarket, this is kind of crazy. I mean, like weird crazy. So Polymarket was making odds on the exact date of the assassination of the Supreme Leader, February 28th. And then it actually happened exactly on February 28th. And there were some meaningfully large bets placed on this. I don't know. It's just kind of freaky. Israel claims Supreme Leader and the majority of the military officials are killed. That clearly seems to be the case. Yet, airstrikes starting on 2/28. Iran declared the attacks illegal. Trump said, we're at war. Although, again, I thought, maybe I'm misinformed, but I thought only Congress can declare war. So maybe this is just media twisting his words, or maybe he actually said that. I don't know. Some make the case that, the war is just a diversion about the Epstein files. Others others said that, Netanyahu threatened if he didn't, strike, then he'd release the real Epstein files, whatever. The really problematic one is on the right, where people are talking about World War III and a nuclear thing, and all of that is obviously less than positive, and not something I really want to think about. But there are a decent number of people talking about that eventuality, which is not good. So you have to consider the source. So every time you look at a piece of information today, One, you got to decide, is it true? And so it took me a long time to find a lot of these slides because there's just a lot of garbage out there. But the US and Israel are painting a picture of Iranian aggression. That's a stretch. They didn't fire the first shots. They're definitely firing back. So there's definitely a war, a kinetic shooting war going on. Now the question is whether it escalates. Do we try a ground incursion, which would be very hard, kind of like Vietnam-esque, part of the world that we're not very familiar with, and I guess very mountainous and very rugged. And actually very large. So even, more problematic than Vietnam. So we'll see how this goes, but there's definitely two sides of the coin here, depending on which set of, someone call it propaganda, someone call it reporting, someone call it media. But you got to remember who controls the primary media. Anyway, so the largest immediate impact on the global economy is the flow of Middle East oil. So that's what so far everything has come down to, this issue about the Strait of Hormuz. Now, the Strait of Hormuz has been threatened to be blocked probably half a dozen times in my lifetime. It actually never has been until now. I mean, maybe before my lifetime, but this is, pretty serious. Now, there's some nuance to it. So you can see on the left-hand side where the oil goes. It's really not to the US or Europe. It's really Asia, and it's really, really China and Korea and Japan. And definitely you can see the, almost dead stop on March 1st, that there really has been very little activity going through on the strait. Now, what is a little interesting, again, depending how deep you go here, is the dependence on the strait, because it is mostly Asia and particularly mostly China. There is an interesting set of, I don't know what you call them, data points that say that not all of the ships are, one, being attacked or blown up or set on fire, which we'll get to in a second, but that there are a bunch of ships that they're allowing to go through that are Iranian flagged ships that are going to China. Now, the other piece is China is playing a different game. I'm not saying they knew that this was coming, but look from October through February at the massive kind of stockpiling in terms of storage in the Yellow Sea, South China Sea. That's an interesting development. So even if the flow slows down, China is not as impacted as we might otherwise think. Now, this is the biggest oil supply disruption in history. And it's not close, right? I mean, this is twice the size of the Suez disruption back in the 1950s, even before I was around. Like I said, maybe before I was around, other bad things happened. But, this is significantly bigger than the Gulf War, significantly bigger than the revolution in 79. So it's a big deal. Now, given how big a deal it is, the price movement in oil has actually been, believe it or not, rather muted. And you can see on the left-hand side that, yes, it is the fastest spike in a year in the futures era, and that's since, the 1980s. It is the largest move in oil in a week since the 1980s. But on the right-hand side, it's the second smallest move. And, in one case, by an order of magnitude of tenfold in a conflict. Now, part of that's the law of small numbers. When you're starting from $11 or $21. It's a lot easier to go up by, 10 times, from 12 to 120. It's harder to go from 56 to 500. Not saying it can't happen, but it's less likely. So after barely a week, Trump gave his equivalent of the Bush mission accomplished, saying that, you know, the war was very complete, pretty much. Not quite sure what that means, but that's what he said. Media has been reporting, and the data actually supports that report, that Iran is running out of weapons. So you can see the number of missiles has definitely gone down a lot. The number of drones has definitely gone down a lot on the left-hand side. That said, they are showing in the last couple of days that they still have a few tricks up their sleeve. And in fact, they struck an Oman fuel depot with drones. So that's a lot of damage for some very small weaponry. And then on the right-hand side, 2 tankers were set ablaze using suicide boats. So there's definitely still conflict going on. There's definitely still war going on. So yes, Iran may have fewer weapons, and maybe we did, with that big bunker buster that we dropped the other day, blow up a bunch of them, but it appears they're still doing okay. Iran actually sent out pretty scary, actually, if you ask me, warning, basically saying we are going after the economic centers linked to U.S. and Israeli entities. So, I mean, this is meaningful, and the reach of the Iranian weapons is real. Like it can hit parts of Europe. So getting to Israel really easy, getting to parts of Egypt and Saudi Arabia where they're U.S. assets really easy. And they really actually named U.S. tech firms: Google, Microsoft, Palantir, NVIDIA, Oracle. That's an escalation that I'm not sure anybody was really thinking about. And this one is absolutely wild. So Iranian hackers wiped out Stryker in terms of basically disabled their entire computer network, stole a bunch of their proprietary data. They claim in retaliation for a U.S. attack on a girl's school. Now the U.S. says, oh, we were shooting at a naval base and it accidentally hit the school. Again, I don't know, but it is interesting, again, how sophisticated this attack was, how broad-based it was, and the impact on Stryker stock was pretty immediate and pretty ugly. So one of the real challenges of what's going on right now is just how unpopular this conflict is. I mean, we've been in a lot of conflicts, especially in the last 30 years. And this is right at the very bottom. Like even Libya or Grenada, Kosovo, nothing is more negatively viewed than this current situation. And interestingly, yesterday, the advisors, not yesterday, I'm sorry, 3 days ago, I got it yesterday. The Trump advisors basically said, maybe you should find a way out. Why did they say that? Well, if you look at the betting market odds, and this is not just since February, it's really since October, the chances for the Republicans winning re-election in 2028 have been falling off a cliff. And the Democratic, odds obviously go in the opposite direction. Basically, voters seem to be saying we're voting our pocketbook. And, one of the things that Trump promised earlier I'm sorry, late last year, was that he was going to get gasoline prices down by the midterms, sub $2. And everybody knows, right? There is a perfect inverse correlation between gasoline prices and presidential popularity, and therefore uh, political party popularity. And so, a month ago, we were at $2.90, still a fur piece from $2. And today we're over 350 and looks like going higher. All right. So in the surprises, go to the biggest one first. The big surprise would be that the fitness report says it all, flies by the seat of his pants, totally unpredictable. The two Cowboys buzz the Iran tower too closely on oil prices soaring. Look, I had no inside information, but that was the surprise. And now we got the surprise that no one really wanted. Now, Goldman had said that excess global inventories were going to put pressure on prices and oil prices were going down. Not everybody was bearish on oil. There were some that said when precious metal prices rise, that tells you that there's going to be a future increase in energy prices. That seemingly is coming true. And it might not have been a coincidence. And the light green is slides that I showed you last time, and I'm showing you again. It might not have been a coincidence that Venezuela was sending their oil to China before we decided to raid, because maybe this is partly about the other war that we're fighting, the chip war with China. So oil prices did get a short-lived momentum spike when we threatened Iran, and there was a little 5-day skirmish, but they went right back down when he backed down. Well, the pivot back to war has sent oil prices soaring. And then when Trump said, well, no, it's pretty much complete, oil prices fell. Well, then more bombs, more stuff. So prices are rising again. Iran says good luck controlling oil prices because we are moving from reciprocal hits, meaning only fired upon, to continuous strikes, and they want to drive oil to $200 a barrel. Now just let that one sink in again. So we're in the 90s today, and the move that we saw on the escalation was a 6 standard deviation move. That's a 1 in 4 million year event. So this is a big deal. Doesn't happen very often. Now, the longer the strait stays closed, the longer and higher oil prices will, or the higher prices will go, and the longer they will stay there. And you can see, the futures curve always says that prices are going to immediately correct back to normal. So saying by September, everything will be hunky-dory, even in a high price scenario. But $100 as hunky-dory is not so great. And the problem is that normalization will take time. So just reopening doesn't make it fine. So you actually have to make sure you clear all the mines, and then you have to make sure that the insurance companies will start writing coverage again, because that was one of the problems. The insurance companies said, hey, you're not covered because this is war. So everybody said, well, then I'm not shipping. And there's that restarting of the engine, which just takes a while. So this is probably going to be worse than people think. So less attention being paid to the actual supply disruption of the Iranian oil fields being on fire. So, Israel struck the oil fields and their refining depots. And, Iran is the 5th largest producer of oil in the world. And granted, most of it goes to China, but it's a real thing because China will have to get their oil from someplace else. So if there's a supply disruption on top of the floating disruption, oil prices could stay a lot higher for a lot longer. So 2 Aranki tankers on fire, and we're right back over $90. The betting markets are saying it's 50-50 that we go into May. Bloomberg I mean, it's almost comical, right? They are comically optimistic. I mean, limited, is the Islamic Republic collapses. Okay, that obviously didn't happen. Ceasefire didn't happen. Limited attacks on energy. Nope. So we're already in their very top scenario, which means, well over $100. And, with a meaningful shock to the system, it's going to take months, not days or weeks, for things to, and that's Goldman Sachs on the right-hand side being more sanguine about the situation. And look, not even Goldman Sachs is giving any probability. I love it. So they, for the fair value and geopolitical risk and the base case and everything's fine, they'll give those reasonable probabilities, but they won't even handicap the upside, or I should say downside scenarios of an oil super surge. So I found that very interesting that they will write about it, but they're not actually going to tell you, what probability they get, which is actually the most important thing. Oil traders have changed their position. So the left-hand side shows, long in green, short in red. And so most were pretty long. And then as prices rose, they got a little bit short, but not a lot short. The real issue is the skew. And the options players, which I'll call gamblers here, the options players are betting on the upside. And this is a phenomenon that's true in all markets these days. I mean, and particularly younger people. And the younger people are feeling less behind the eight ball. They're not feeling as financially secure. They don't have a house. Maybe their job's not stable. So they are gambling a lot more, and options in things that move or something they're gambling on. So oil market volatility is at, again, levels we just haven't seen. And what's crazy is, let alone the left-hand side where we're up 30%, down 30%, within a day. Again, that's a 6 standard deviation event. The right-hand side is, I think, even crazier. We're talking, 5, 10% moves on a single social media post, or the removal of said post, or the reposting of said post with a correction. It's pretty crazy. So retail investors doing what they do best, buying what they wish they would have bought. Last Friday, they set a record. Literally the red arrow in the middle. I mean, almost top ticking it almost exactly. And they, woke up Monday feeling a little sheepish, but did that stop them? Oh, hell no. They set a new record and bought more, almost at 20 times the normal daily volume. The G7 does have some ability to weather price disruptions, in the sense that there is a reasonably sized 1 billion barrels SPR globally. The challenge is it's different for different groups. Japan and US are in pretty good shape. Germany in pretty good shape. The rest of the Europe, not so much. And Canada doesn't worry about these things because I guess they feel like they have plenty of energy. But the real issue is, historically, when you release the SPR, it definitely can push prices down. So you can see the Gulf War, it took prices down from 40 to 20. After Katrina, it did take prices down from 80 to 60, but then they went right to 140. Libya, it was 120 to 100, and then we're right back at 120. So it doesn't work every time, but it gives us some flexibility to weather a really extended period. Now, one thing to think about, and an important point, is in real terms, oil prices are not that high. And just means that they could go significantly higher. The other thing that's important to remember is an oil shock is really only an issue when equity valuations are high. The problem is equity valuations are really, really high. So it's probably a problem. Now, the metals ran dramatically in the second half. Energy should follow. Literally, and I mean literally, and I forgot to turn these things light green, so I'll do that later. No one owns energy. In fact, most people are short. Big oil, best run of this century. Now, this century is only 26 years old, but still, it's unbelievable and crushing everything else in the market. So, we talked about energy being a good place to be, and it certainly has. Despite strong recent performance, literally no one owns any energy. I mean, sub 0.5% in terms of US energy ETFs relative to all ETFs, and global energy weight at the lowest it's been. Oil services stocks had been en fuego. Unfortunately, now some are actually on fire. So even those have rolled over a little bit. But it has just been a spectacular run for oil services over the past 9 months. MLPs continue to be one of our favorite investments. You're talking 7-8% yield plus. Now you've already got 13% growth. I mean, these things are just money in the bank. All right, fire when I'm goddamn good and ready. The surprise is that the admiral makes a pilot change. The new guy crashes the plane. You could have driven a truck through Q4 estimates, right? The Atlanta Fed said 5.5. The estimate, blue chip estimate, was 1. We came in at 1.4. The truck actually hit the GDP, and we ended up for the year barely over 2%. So kind of a crappy technical term year. Wall Street prognosticators said everything's going to be great. We're going to be right back up to 2.8%. I'm sorry, no. 2.8% this year. That ain't going to happen. When job growth reaches these levels, recessions follow 100% of the time. We'll see. When Fed cuts rates, recessions always follow. So if Warsh keeps cutting, we'll see. Look, despite the economic concerns, there was no recession in 25. 26 probability had collapsed up until a week ago. So now we're back to, 34% chance of a recession this year. We'll see. The oil price spike varies globally. So in the US, or let's start with the EU. The EU, it's not so much about inflation as it is growth. I mean, it's a meaningful hit to growth. In the US, it's really not about growth. It's about inflation because we include oil in the CPI. In Asia, China, pretty much good. They're insulated. But some of the other countries, Singapore, Taiwan, Hong Kong, I mean, we're talking very, very meaningful hits to GDP if this oil thing goes for very much longer. Now, the Atlanta Fed, curiously, actually bumped up their first quarter GDP number this week. And the logic is, which I think is flawed, but it's their logic, is that consumer spending goes up because people are going to have to pay more for gasoline. Well, yes, that's true, but they're going to have to take that money from somewhere. And my guess is it's going to come out of other consumer spending, but we'll see. Because they can't really borrow much more. And well, anyway. So the February CPI print was very stable at 2.4, but that was before the war started. So people are already saying we could be well over 3% for March. We'll see how that plays out. In theory, and this I say in theory, the U.S. is less vulnerable to oil shocks. Left-hand side is, our amount of GDP produced per unit of oil is definitely lower. Well, of course that is because we outsourced all the production to China. However, we're a consumer economy, and this recent oil spike would totally erase the 1.2 trillion we were expecting from tax refunds to boost economic growth. So I don't know if I buy the argument that we're not as subject to oil. All right. If I can't shoot the SOB, at least I'm gonna have some fun with them. Global debt bubble pops, funding costs spiral out of control, and long rates reach Mach 10. So Fed Watcher said no more rate cuts for a while. Money supply growth would accelerate. Government spending was out of control. Now it's really, really out of control. Look, there is a global debt crisis. Everywhere you look, interest rates are rising. And with massive amounts of debt and interest rate costs rising, that is a recipe for disaster. Now, total global debt has now reached global GDP, which has only happened one other time in history. And that led, well, maybe not led to, or maybe it was just, correlation doesn't mean causation, but some make the argument that we went to war to erase the debt. Doesn't really matter at this point, except I don't like world war in anything we talk about. But that's kind of where we sit. U.S. bonds, in theory, U.S. bonds are supposed to be a safe haven. When we go to war and there's global uncertainty, everybody's supposed to buy treasuries. That isn't happening. The spike on the right-hand side of both of these charts is very troubling. The direction is troubling. The amplitude is troubling. And the fact that it just blew right through the 200-day moving average is even more troubling. So this puts pressure on interest rates. It puts pressure, I mean, it is interest rates. It puts pressure on interest rate costs. It puts pressure on economic growth. It puts pressure on lending. It puts pressure on everything. So this is not supposed to happen. And the fact that it is happening, I mean, there's a whole set of cascading problems, but it's bad. So the massacre on the long end of the Treasury curve should have led to a selling catharsis. Well, it did. And on cue, like literally almost to the day of the 10 surprises, people started buying TLT again. But as soon as the bombs started dropping, they dropped treasuries like a hot potato. So that's just a weird dynamic. Corporate credit spreads near the lowest ever, so we should issue more bonds. Well, of course we should. AI, we need more cash. We don't have it, so we'll just borrow. Hyperscalers, I got to build these new buildings, so I'll just borrow. There's just something weird about the circularity of everybody passing around the same $1 trillion, because it's not real earnings if it's just circulating dollar. Well, the software debt maturity wall hits a crescendo in 28, dominated by lower quality issuers. That's a problem. Now, how big a problem is private credit? And these are part of the private credit problem. Is this cycle subprime? Like, are we on the verge of GFC2? History doesn't repeat, but it rhymes. So this is a, $1.2 to $1.5 trillion issue, depending on who you talk to. And when you look at the argument, it sounds kind of similar. I mean, the highly levered private equity corporates are just like the highly levered households. The CLO structures, the shadow banking system, the PIK toggles. I mean, all of the things are pretty much the same. And then we had the, subprime is contained quote, and this time we had private credit is contained. That's not good. So this analyst, I thought this was cool. They fed the PC, the private credit research, into an LLM, and they got this infographic. And again, it's a little wonky, but it's actually pretty good for a one shot. But it's not good news. And what it's telling us is we've got a $2 trillion problem. And $2 trillion is enough to plunge the economy into a pretty dark place, just like the GFC. All right. Now, in recent weeks, the banks have basically closed the doors on a whole bunch of, these funds, private credit funds, to try to stop bank runs. Now it's kind of like doing it after the horse is already out of the barn. And of course, in the bottom right-hand corner, Goldman Sachs is like, "Oh, no, we got you. We'll write you a contract to bet against this." Well, again, maybe you should have sold me that instead of selling me the private credit fund. You could have used it before the problem, because here's the problem: is the defaults have already quadrupled, and the markdowns have already occurred. So we're talking 30, 40, 50% markdowns. And so the investors have said, "Give me my freaking money back." And the funds have said, "We can't do that because your money's not here." So not only that, the sponsors of these funds, the shadow banks, are in absolute free fall. So you can see the individual Apollos and KKRs and stuff on the left. In the middle, here we are about 2-3% from the all-time high in stocks, and the private equity index is down about 20%. And some of these private equity companies on the right are down, like Blue Owl and others are down 40-50%. So again, who would have thunk it? Lending money to high-risk borrowers for cars was a bad idea. So on the far left is this Toronto-based company, or I guess they're Canadian. I don't know if they're in Toronto. They're listed in Toronto, but Go Easy. So easy come, easy go, and this is probably going to zero. On the right-hand side are the big U.S. lenders. They're not going to zero, but they're going down a lot. And it's worse than that. It's actually all of the banks and financials are the worst sector so far. And so, yeah, fine. They're the worst sector, but they're not down that much because the market's not down that much yet. But on the right-hand side, it just shows the headroom. And if you look what happened in the Ukraine war and where oil prices were, and now look where oil prices are, that's a fur piece. That's a long drop. So we talked about this last time. One company in particular looks like the proverbial canary in the coal mine, and it's given off AIG vibes, and that's Oracle. Sam was writing checks that his bank account can't cash. Investors calling the bluff. So yeah, Oracle jumped when Sam said he was going to give him $300 billion, but he doesn't have $300 billion. So the stock went down a lot. Now here's the real problem. Oracle used to be a free cash flow machine. Now they just burned $25 billion in less than a year. So the stock is in absolute free fall. Now they beat earnings the other day. That's in air quotes. And the stock actually rallied a little bit, and then it went right back to falling. And yeah, they lower the earnings estimates so far that they beat it, and then people get fooled by that for a couple of days. But you can see it's like a rubber ball bouncing down a set of stairs. The end of the trip's a bad place. They lost $500 billion of market cap, but yet we're able to sell $41 billion in debt. I don't understand who would buy this debt. I mean, I really don't. I mean, I guess it's the passive indices that don't get to think, but no one should buy debt of a company with a 500% debt to equity ratio. You just shouldn't do it. And, I love the headline. Oracle's building yesterday's data centers with tomorrow's debt. And yet they just handed out 30,000 pink slips. It's not a stable company. Anyway, despite your best efforts, you refuse to die. Bear won't be happy till he's going Mach 2 with his hair on fire. Equities crash and burn. 90% of people thought returns this year would be positive. Bullish sentiment had almost never been higher. Why did Uncle Warren go to cash? Now, did Uncle Warren know that this was all coming down the pike, that we were going to attack Iran? I'm not saying he did, but I don't know. It's one explanation. Why did individual investors put large amount of cash, the highest amount in money market funds ever? They probably didn't have inside information. U.S. equities clearly not having their usual positive reaction to the conflict. So U.S. equities were dead flat up until the conflict, and now they're down a couple percent. And the problem is, if history is any guide, we're in for double-digit drawdown. Overall, the equity markets are not terrible, but if you look under the hood, everything's bad except energy. So tech is the worst, consumers next, real estate's bad. So everything's bad except energy. Institutional investors were betting in January that the Fed had basically eradicated volatility forever. Now, VIX was saying, no, there's something bad going to happen. In fact, VIX was telling us that something bad was going to happen in mid-February. It's pretty damn good. I mean, it was February. It wasn't mid-February, but VIX has jumped. And if you bought, VIX, you made a lot of money. Now, the reminder is when VIX is 12, it says, or when it's less than 12, it says something bad is going to happen. When it's in that 12 to 14 zone, it's basically saying nothing bad will ever happen again. So when it gets down below 12, that's when you want to buy it. When it's where it is today at 25, it basically says something bad is happening. And on the right-hand side, when it's at 25, the next 12-month returns are basically not very good. Earnings growth, first time in years, it was actually driving stocks. But the tough comp, anytime you have earnings grow at 15% for 5 years, that's as good as it ever gets. That's where we were. The longer this conflict goes, the more negative the impact on earnings. That goes without saying. And my guess is that earnings estimates are going to come down a lot, which is going to put pressure on stocks. U.S. equities were, past tense, the most overvalued on every measure in history. Now they've come down a little bit. The 2000 analog is pretty striking. I mean, this feels like 2001. It feels like the debt unraveling around tech, kind of the same way that it did back then. Third year of the presidential cycle is always tough. Usually sell in May and go away. This time it was earlier. Look, U.S. stocks actually have never been this overvalued. Just full stop. I mean, a couple days ago they were. But it's been this way for a while. I mean, we've been higher than 2000 for a long time, and we've actually been higher than 1969 for a long time. So it doesn't mean it has to crash tomorrow. But anyway, what do you mean it doesn't look good? It doesn't get any better than this. So the surprise would be that the Mag 7 lag 7. Everybody loves Mag 7. Everybody loves chips. Memory prices were flying. Now, the Korean equity market, which had just been soaring, got shot down by the Iran conflict. And even SanDisk was not bulletproof. Now, it didn't go down. I mean, it's flat, but it didn't go down. But it's still trading at a crazy level. And however, DRAM prices are rising. NASDAQ to M2, highest valuation ever. NVIDIA, we talked about all this stuff, Palantir. So the SaaS apocalypse is real. SaaS companies have gotten smashed. Small cap beat large cap 13 days in a row. Small caps are not considered a true safe haven when the bombs start dropping. So that string ended almost exactly the day of the assassination. So ego writing checks your body can't cash. Dollar. Look, the dollar's role has been eroding. Maybe this is a way to try to keep it that way with petrodollars. This was hyperinflation vibes in January. Not saying that we were going to Weimar, but it was starting to feel that way. Everybody jumped on the debasement trade. Middle Eastern war and oil price surge is always good for the dollar. That's why the petrodollar system was created. Now, the question is, how durable is the rally? We broke through the 200-day. I mean, this is, we're modestly up for the year. So Everyone thought the dollar was going to continue to go lower, so that usually means that's not going to happen. Um, Dollar dominance definitely shifted in 2025. The emerging markets was, past tense, beating the US by the most in years. But as soon as the bullets started flying, safe haven no longer. So she lost that love and feeling. European markets, look, it's pretty bad when the consensus thinks you stink. Lowest growth forecast of the world. The last thing Europe needed was a rising euro. Okay, so the euro has been going down. That's good for Europe. However, it's not good enough because Volkswagen had to lay off 50,000 people, and Porsche another big number. But not surprisingly, European equities got shot down by Iranian missiles flying, and both Fez on the left and EUFN, the banks. So all the European stocks also struggling, as you would expect. Now the Japanese prime minister has, tried a bunch of stuff, this stimulus package, changing geopolitics. Most people didn't have Japanese stocks as the best performers last year. This lady came to power literally out of nowhere. And again, not that this matters, but it is interesting. I guess Japan has it's kind of like when there was a Jewish president elected in Mexico, which doesn't have a very high Jewish population, but it's even lower in Japan. It's like 0.002%, and yet she got elected. But $1 trillion here, $1 trillion there. Pretty soon we're talking real money. Bond vigilantes came after her. They did not like her populist agenda, and Japanese bond yields went crazy. Complete decimation of the yen in gold terms meant they needed to buy some gold. So they, along with China, jumped into buying gold. And look, Ueda-san on the left-hand side of this chart said, I want a stronger yen. Now, stronger yen is usually not good for Japanese equities. But global market chaos has basically said, sorry, Ueda-san, we're going to unwind the global carry trade, and the yen is not going to do well. So Japanese stocks usually like a falling yen, but they like falling bombs less. So the first part of the year, Japanese equities were the best of the bunch. But now they have turned into the land of the blazing sun, and we'll see how the rest of the year plays out. All right, you're still dangerous, but you can be my wingman. China dominates a couple things. One, they dominate Asia. Two, they dominate rare earth minerals. They are stimulating their economy at a level that none of us have ever seen. Their trade surplus is at a record because they're playing a different game. They're playing Go, while the rest of us play chess and checkers, and it's working. So China's selling treasuries, buying gold, so they're exchanging paper for rocks. That tends to work. I forgot a slide. Basically, I was just going to show that Chinese equities, despite all of that, have not played out just like everything else. They've been sold too. In case some of you are wondering who the best is, we think that Bitcoin will get through winter here by September and start back up. Bitcoin died 4 times in 2025. It's up to 471 obituaries. I love this. If you just bought $100 every time it died, you'd have $73 million. It's pretty amazing, actually. Everyone was focused on this Benner chart. Is it as simple as following the money? If we get $4.7 trillion of liquidity, we will have much higher Bitcoin. Now, that 1.2 trillion in tax refunds probably just got obliterated by higher oil prices, but the corporate dollar repatriation is going to happen and the bonus depreciation is going to happen. So we'll see. Bitcoin has never been this undervalued relative to gold. Not everyone was bullish on Bitcoin. Some people thought that we were headed for 30,000. I think that's unlikely at this point. Crypto more broadly continues rapid growth. Tokenization of real-world assets is surging. Figure technologies. So we're excited about Figure. This guy's created a, 10 or I guess $8 billion company today from a standing start back in 2018. Some smart investors agree. Ethereum is the chain of choice, although you wouldn't think it given how Ethereum prices have been. Stable coins, this is the jam. And I don't think I put it in. Yes, that's supposed to be a picture of Circle. I'll put it in and post it. While the fuss about the Clarity Act, look, the banks don't want stablecoins to pay interest. They like making $300 million a day by paying no interest on deposits. I hope that the Clarity Act doesn't get passed in its current form. I hope Brian wins. I hope we don't give in to the banksters, but we'll see. Gold, we thought that gold ran too far too fast. It was going to take a pause that refreshes. It has indeed done that. It has stopped. These trends tend to persist for a long period of time. Silver, it's down a little bit. It's paused harder. I'm not saying it's necessarily going to crash, but gold miners leveraged exposure to gold. Chart was overbought. So we said, probably a pause that refreshes. And indeed, they are catching their breath. US dollar hegemony is anchored by oil and the petrodollar system. So it should not surprise anyone that any country that touches petroleum has been involved in a conflict this year. So, we're trying to preserve US dollar hegemony. And, at this crazy, at the current gold price, $5,100, oil would be 170 if we get back to a 30. So that you can see that range of 20 to 40 on the left-hand side. 170 is a long way from where we are. All right. So Around the World is on Apple Podcast, as is Hedged with a capital D, as is Digital Currents. We'll record a new one tomorrow. And added a new book here from Rick Edelman, The Truth About Crypto. Rick's a great guy, great writer. And that is it. And I will see if there are questions. All right. So a question about Russia and Iran. Look, there's no question that there are alliances or axes or whatever you want to call them. There has been less evidence so the question is, supplying arms. There's been less direct evidence of, a meaningful kind of arming the combatants. I don't have any inside information on how many of Iran's arms come from Russia versus come from the United States, kind of like, Tony Stark, where both missiles being shot at each other come from the same company. I really don't know. It does appear that the Russia, China, Iran, Venezuela, handful of other country axes economically for sure. And whether that includes military, it's probably likely. So the follow-up question I'm less. So the question is Russia kind of creating the chaos? There's a legitimate argument for that, in that one of the biggest beneficiaries of rising oil prices, other than Saudi Arabia, is Russia. Russia's government tax receipts will double if oil stays around $100. So you could make an argument that they have a challenge. I'm sorry, they have a benefit. So I actually take the other side, right? I actually think this has more to do with Israel's global aspirations. There's a very interesting thread on plans for a new canal to be cut through Gaza, or what's left of Gaza. So in the end, it's always about oil. All of this conflict for the last couple hundred years. Um, but I probably side less with the people who say this is Russia and China, and more with the people who side with, this is Israel and therefore, by extension, the US. Um, but we'll see. I mean, look, the US for the last 30 years has attacked anyone who threatened petrodollar hegemony. Full stop, right? Libya wanted to price oil in gold, took Gaddafi out. Iraq wanted to price oil in euros, took Hussein out. So that was clearly on us, and that was all part of the plan. You can go back further in time, and you can find links to oil and gas in just about every armed conflict. Now, can you make a case that it's more complex than that? And sure. There's another question here about what about if Russia can't get their ships out? How do they supply the oil? That is what is being rumored. Again, I can't confirm or deny this, but what's being rumored is that Iranian, Russian, etc. ships are being allowed to pass and are not being attacked, and they use different shipping routes, and the flow of oil and gas from Russia seems to be unencumbered. I said the stockpile of Chinese oil from Venezuela, Russia, and China seems to be very high, and that's all verified data from IEA. So, my guess, yeah. Fed hearings, what's going to happen? Look, Warsh is going to come in, and everybody believes that he's going to be this giant dove because Trump wants lower rates or needs lower rates, and Bessent needs lower rates. I mean, certainly possible. And it's definitely it's a good question, because it's definitely more likely that the Fed would cut rates in a scenario where GDP is, sub 2% or even, trending to negative. When they were making noises about GDP being 5% in Q4, there was no way you could cut rates into that. No way. Be way too inflationary. The real problem, in my mind, is the midterms are shaping up to be a disaster for the Republicans. I mean, disaster on all the polls. And why? Well, because the average American is less well off than they were 2 years ago. And, not the people at the top. The people at the top are doing great, and anybody who owns assets is doing great. But man, if you need to put gas in your car, heat or cool your house, send your kids to school, get health care, I mean, it's brutal. I mean, there's a lot of data out there that says that CPI print at 2.4 is total myth. But we'll see. BTC gold. Do you see BTC gold? Okay, yeah. So I think gold had its run. I think gold had a parabolic move based on a massive short squeeze. Gold prices were dead flat from 21 to 23. Bitcoin up prices were up a lot during that period. Gold caught up, so to speak, and got out of its jail. Bitcoin's kind of been in that same jail for the past year with the futures prices, kind of what Leo Melamed said. They would tame Bitcoin with futures. I think that trade is getting long in the tooth, and I think the spot demand for Bitcoin is rising. You hear all kinds of stories of people trying to buy Bitcoin in places like Iran and Turkey and Venezuela. I think the tamping down will continue for a while. At some point, they'll lose, and I think that Bitcoin gold equivalence, goes right back to where it's supposed to. But I think gold is kind of dead money for a while, unless they start printing, dollars, which, look, if this war gets really, really bad, and what do you mean by really, really bad? I mean, if they actually start going after U.S. targets, if they really kill some U.S. civilians, if they, um, if if we, meaning us in Israel, kill too many Iranian civilians and they get on the news, I think things could get pretty ugly and pretty entrenched, and then you get economic malaise. Oil prices go to 125, 130, 140. Economic growth falls off a cliff. The money printer has to come out. And then I think gold could go up too. But I think then Bitcoin goes up a lot more. So, all right. That looks like the questions. I appreciate everybody hanging around. And we will be back soon with another Around the World and a bunch more fun stuff. Join us then. Take care.